Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. The double top formed over late April to mid-May saw its targets reached on the downside last week. However, this had not stopped the decline. Prices continued lower last Friday and into the middle of this week, punching down and closing below the 50% absolute Fibonacci line at 675, the 50% Fibonacci line from the big 2012-2015 move at 670, the recent 50% Fibonacci line at 668, plus both the short medium moving average, currently 669, and the medium moving average, currently 663. All these supports, now resistances, may not have stopped the move lower, but they did erode the bullish incentive. Enough that when the market came down to the lower tine of the big December 2020 to March 2021 Andrews pitchfork, currently at 653, it was halted on Wednesday, this past Wednesday, with a bull hammer. This led to yesterday's bullish opening long white Mariposa. Now the question now is whether yesterday's bullish move back up is just a reactionary pullback up, or whether there is more to it. Now, I did mention last week that the market was also entering a congestion zone from January to March this year between roughly 636 and 675. Within this, we obviously had the previously mentioned levels, but there is still some more support below. However, I did mention last week some possible levels for a pullback up from the recent fall. Now, I said last week overall, and I quote, overall, it is a little too early after the double top pattern to start seeing new patterns emerging. But it's not too early to start thinking about a possible pullback up from the fall of the double top. So, if it should start from the beginning of the congestion zone, then it could stretch up to the 706 area. If it should start from the lower tine, then we might see a pullback up to the 691 area. This is all hypothetical right now, but it's worth remembering just in case, and that's the end of the quote. Well, the situation is now no longer hypothetical. We have seen the start of a pullback up yesterday. Now, one assumes it's just a start, but with a high of only 683 today and what looks like a bearish harami today as well, there may be concerns that this pullback we've seen may be all that we'll get. I'm still minded to look at the lower tine as being key. As long as this holds on a closing basis, then we may still have a pullback up towards the 691 area. Failure, and we could even be looking at the action moving down through being the first part of a bear flag, throughout May. And that could see a move down to the 570s. At this moment, I'd rather wait and see the eroding effects of the former supports, turned resistances, turned back into supports, and finally turned, in some cases, into resistances again. Chicago corn. It is obvious from the high of May to its low, we've seen a drop that has been helped by the changeover. It is one of the occasional restrictions under which I work, of having big gaps in the market at change time. In this case between 641 and 572. Though I have seen worse in Paris rapeseed and Paris milling wheat that have since been filled. Anyway, the drop slowed last week in between the short medium moving average overhead, currently at 595, and the medium moving average below, currently 568. However, this week the market took a further trip lower with a key reversal down and bearish engulfing pattern on Tuesday. Yet this drop was seemingly not held, as the very next day we had a hammer pattern, usually seen as a bullish reversal, and based on the important combination of the 2014 high and the 61.8% absolute Fibonacci line, both at 525. Then yesterday, a big bullish white Mariposa back up. This drop was interesting because of where it held and the closes. I've already mentioned the low of the market, but prices also failed to close below the 2021 uptrend, currently at 539, despite breaching it. And we only really had the one clear close below the significant August 2020 today uptrend, currently at 550. As I said last week, one of these two uptrends may soon play a more significant role. This is because one of them may be the uptrend for a possible bearish bump and run reversal top. It is still a bit too early to say which, if any at all, but it would be as good a way as any to explaining the nascent pullback up and what may happen next. You see, if it is a normal pullback up and away from the drop, then the move up to test the 600 area would be fine, maybe then even making a new pattern after that. However, if it turns out to be a bearish bump and run reversal top, then we'll also see a pullback up to the similar levels, but then a turnaround back down and a possible fast move lower, especially if we move below the 520 level. Hence, it'll be interesting to see how far this pullback up goes and if the market stays pulled back up. Now, one final piece of significant information I'd like to share. Though it's not perfect, we may well be on for a weekly key reversal this week. The criteria is set. It is just very much depends on the close tonight. So if we close tonight either over 573 or under 542, then that would be on. Anything in between, I would have the lesser outside week. Well, right now we're shading towards a weekly key reversal up, but only just. But that may open up a lot of possibilities. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.